On the one hand, the Reserve Bank's trying to slow our economy to quell inflation. On the other hand, this week we've found the latest figures are suggesting that we're creating lots more jobs, unemployment is holding reasonably well, and wages are rising. So what does this mean for the Reserve Bank when it discusses interest rates in December? That's what I discussed with Dr. Andrew Wilson today. If you want to keep up to date with what's going on in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. We know in its bid to battle inflation, the Reserve Bank was hoping to raise the unemployment rate and quell wages growth. But the latest unemployment figures were stronger than many expected, and wages have kept rising. So what does this mean for our economy, and will these figures be taken into account when the Reserve Bank decides what to do with interest rates in December? These are questions I'd like to ask Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yes, good day, Michael. Interesting data we have had released on the economy over the past week. I think once again, the jobless numbers were very strong. This really hasn't changed. I think we've had quite a remarkable period over the past year with the unemployment rate just continuing to hover around those record lows, 3.5, 3.6, 3.7.
Like more jobs being created, Andrew.
Yeah, that's right, Michael. This is the point. It just sort of fluctuates around the other labour market numbers, but it has been a very consistent period, a remarkably consistent period over the past year with those low to mid 3%, which are really unprecedented in the modern era. And they're certainly unprecedented with the monthly surveys that the ABS now conducts. We did have numbers around about that level in the early 70s, but that was a quarterly measure of unemployment. And it was, of course, a much different economy with certainly not as many wage earners per family unit. So it's an extraordinarily strong labour market, and it just shows no signs really of easing. So the October data, unemployment rate just tickled up a little bit to 3.7%. But we had another big month of job increases, Michael, and this is quite astonishing. The previous month, we had 8,000 jobs created, which is a reasonably good result. But it followed a very big month over August of job creation. And now we've had a big month over October. 55,000 jobs were created. This is a really big numbers, Michael, that we're still creating jobs in our workforce. The unemployment numbers rose, and that's why we saw the higher unemployment rate. They're up by 28,000. But we've had a period of over the past few months, the previous months to October, where the number of unemployed have actually been consistently falling. So this was just a bit of a rebound from what we've seen, declining numbers of unemployed back up again, and they're up by 28,000. But the really remarkable number, Michael, is another record high participation rate, up by 0.3% to 67% participation rate. These are unprecedented numbers, and it means that we've got people coming into the workforce from the potential workforce in unprecedented numbers. And of course, these are small business people, perhaps retirees, those that have been marginalised, that are being attracted by all these jobs that are available at the moment. And it's not something I think the Reserve Bank wants to see in terms of controlling inflation. We've just had no sign at all of an easing in our labour market along through the theory of higher interest rates quelling demand. And we do really, I would believe, have to see unemployment rates pushing above 4% at least before we had a sense that the higher interest rate policies were working to quell inflation. The jobless numbers, New South Wales was again the strongest state for unemployment numbers over October. Their unemployment rate is at 3.4%. Interestingly, that some of the states are actually recording higher unemployment numbers over October compared to October last year, Michael. But I don't think really there's anything in that to be sort of saying, well, things are starting to work in favour of the higher interest rate policy quelling demand. These numbers are still very low. no real sign that higher rates are doing the job that the Reserve Bank would hope they would be doing by now. And in fact, the Reserve Bank's now saying that its target for unemployment, or its forecast for unemployed next year, is a lot lower than what it was. So even they're conceding this very, very strong labour market.
This is really showing another strength in our economy. Now, there's no doubt that people are hurting. There's no doubt that rents are going up, mortgages are going up, the cost of living is going up. So some Australians are having challenges, and wages are going up as well, which we're going to discuss in just a moment. But it is a sign that the economy is doing much stronger than the Reserve Bank would have liked in its bid to slow down inflation.
It does bring into question what we've been discussing over months, is that why did the Reserve Bank pause rates in May? I mean, when there's just been no sign, and I mean, they've been virtually forced to backtrack on their rate pause position with that rise that they announced 2 weeks ago, the November rise. And I think, seriously, with these numbers, more rises certainly have to be on the cards, because there's no sign that higher rates are working as they're supposed to work. And it's just been, in my opinion, a period through winter and into spring of missed opportunities for the Reserve Bank to continue to push on the brakes to try to control inflation. And I think that given these numbers, again, that we have to see more interest rate increases to get the job done, which is not even showing any early signs of improvement. The only improvement in inflation really has come from lower fuel prices. You know, underlying inflation is still way too high. And when we see the latest wages data, which we'll discuss shortly, we can see that real wages are continuing, even though we've had a big rise, real wages are continuing to fall. So to your point that people are doing it tough, really, that's what we're seeing in terms of what's happening with real wages. And our real wage position is one of the worst in terms of advanced economies.
Well, Andrew, there's always been concern about what happened in the past with the wages price spiral. But as you said a moment ago, inflation has gone up more than the latest increase in wages. So there doesn't seem to be a sign of that happening just yet.
No, well, the ABS released its latest wage index data, Michael. It is backward looking. We're talking about the September quarter here. But nonetheless, it's really all that we can go on. But really, we discussed when they had the previous release, which was for the June quarter, we actually saw the rate of annual wages growth lower than the previous March quarter, which was just confounding. You know, it was illogical given how strong our labour market had been, record low unemployment. And yet we saw the annual rate of wages growth fall from 3.7% in the March quarter to 3.6% over the June quarter. And we discussed this at length, that it didn't really make a lot of sense. And we have had some issues with some of the ABS data. We've discussed that as well. And this was another example. Perhaps it's a part of their issues that they have with seasonal adjustment coming out of COVID. The other point is that Australia has a very sticky wage setting environment. We have annual and sometimes 2 yearly wage reviews. That demand force that's obviously there in our labour market with surging jobs and very low unemployment takes some time to work its way into wage increases. And we, of course, have had a national wage increase, which is fueling the results. But having said what went before, which was a big surprise, I don't think it was a surprise, the latest September quarter result. In fact, the index surged by 1.3%, Michael, over the September quarter, which is an extraordinarily high number. Maybe there's a bit of catch up there given the low number that was recorded over June, which, as I said, left a lot of questions to be answered. But up by 1.3% over the September quarter, and now annual wages increasing by 4%, Michael. And this is what we speculated, that we expected to see a 4% number given this very strong labour market. But that is a record high in the ABS series. At 4% annual increase is actually a record high. And we shouldn't be surprised at that, Michael. And given the issues with lagging wage settlement positions, as we discussed, those annual reviews, 2 annual reviews, we can only really expect this to go higher, given how strong the labour market continues to be. And if anything, it's strengthened over the last, in terms certainly of job creation, has strengthened over the past few months. So we may see, when we get the December quarter data, which of course is some time off now, an increase over that 4% annual result. But look, good news, Michael, you said that people are doing it tough. This is what they want to see, obviously, is that 4% increase. But at the end of the day, underlying inflation is rising at 5% at the moment, Michael. So that means that real wages are actually falling by 1% per annum. And that really puts the whole scenario quite clearly in terms of tough times for Australians, regardless of low unemployment and surging wages. This is the offset that higher prices are doing. It's just not covering higher prices at the moment, Michael. And as you said, this results in tough times for consumers.
Well, when you break it down even further, it's really been the private sector that is where wages growth has occurred. There's an average increase of around 5.8% in the private sector, and the public sector had lower growth this time around, Andrew.
Yeah, and look, once again, this is not what the Reserve Bank wants to see. It wants to see, and it would have been happy with the previous results when we did see annual growth decline from that 3.7 over March to 3.6 over June. But now it's going the other way with a record surge in wages. And of course, the point here is that employers are going to have to cover that record surge, which means upward pressure on prices without the productivity gains that we want to see in terms of justifying higher wages. So again, this puts upward pressure on inflation as employers look to cover those higher wage costs with higher prices. And again, that will motivate workers to look for more wage increases to cover those price increases. So accelerating wages are certainly a factor in rising inflation. Not good news for those that are hoping that we're not going to see further interest rate increases. And we've just seen before that all states are continuing to report low jobless numbers. So we're seeing some signs that we may see an ease in wages growth. So we've really gone nowhere, Michael, in a sense, since we started to raise rates in May of last year. Nothing's changed. And from my perspective, logically anyway, that only means higher rates down the track.
Well, it'll be interesting to see whether the Reserve Bank does it in December or waits, because then it's the lag. It doesn't have another meeting until February. And sometime next year, the new system starts. I'm not sure we really know exactly when that's going to be, when there's only going to be 8 meetings a year. I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Now, Andrew, each week we discuss the auction markets. It's the end of the spring selling season, only a couple of weekends to go. That's usually the time when there's more properties for sale as well, vendors wanting to finish off their transactions and move, buyers wanting to get in before Christmas. So there was a surge of listings. How did the market cope with that?
Well, we've discussed this also recently, Michael, that there is this seasonal impact on our weekend auction markets through November into December as the market shuts down, as it loses focus with the holiday season approaching. We do see lower clearance rates. We see that every year, regardless of the cycle. And this year is no surprise. We've had a strong auction year this year, as we've had generally a strong housing market this year. It's been in catch-up mode given the losses last year, which by and large have all been accounted for in most of the capital city markets. We had clearance rates pushing up around 80% in Melbourne and Sydney in May and into June, Michael, which of course is a boom time result. But again, that was just that catch-up market taking advantage of affordability positives with prices lower than they were the year before. But we've caught up with a lot of that, Michael. So that's the first point, that affordability issues are starting to impact the market. A lot of that pent-up demand has been satisfied. And of course, higher prices are pushing buyers out of the market. So No surprise that clearance rates are lower. But the other factor, as you clearly indicated, we're getting a surge in listings coming in. And that, of course, means there are more choices for buyers and there is more competition for sellers. So no surprise, we're starting to see clearance rates ease. Still probably generally in favour of sellers at this point, but certainly a much more balanced market between buyers and sellers. And I think we will see that trend continue for the rest of the season. And we've only got 4 weekends left, Michael, so expect lower clearance rates. But I think at the end of the day, it's actually a good opportunity for buyers out there to take advantage of some sellers who are looking to sell their properties before the end of the year. So some good buying out there, so perhaps some better buying out there, less competition for properties and more choices.
That's a really good point, Andrew, because people have gone to the emotional trouble of putting their properties on the market, advertising them, whether it's for auction or private sale. They want to finish at the end of the year. And rather than worry about what's going to happen in 3 weeks or 3 months, you should really be looking at where our property markets are going to be in 3 years or 30 years. And so if you have a long-term view of how our economy is doing, what's happening to our population, the supply-demand inequalities with still strongly growing population and not enough supply, you're right. There's a window of opportunity at the moment when there's properties that may be just a little bit easier to get because there's a bit less competition.
Well, it's the old truism, Michael. It's better for sellers early in spring and it's better for buyers late in spring. And that, again, is revealing itself with the latest data. So if we have a look at the results from last Saturday, another big weekend for Sydney. Sydney's still tracking around about year highs for its listings. 875 auctions reported in Sydney last Saturday, which was higher than the weekend before, which was 862. As we've discussed, the clearance rate eased with those higher numbers of properties being offered and with those other issues that always confront the market towards the end of the year. And of course, we are coming to the end of that catch-up cycle as well. So 67.2% clearance rate in Sydney, below it where it was at the same time last year, Michael, which is the first time we've been able to say that for a while, but just below where it was last year at this time. But you can see that the auction numbers are significantly higher this year in Sydney compared to the same weekend last year. And what I would suggest to you is when we look in comparisons, year-on-year comparisons, clearance rates are around about where they were a year ago in most of the capitals, but the number of sales is much, much higher. So the actual numbers of sales that are occurring now are significantly higher than where they were a year ago, Michael, which still shows you that there's quite a reasonable appetite for property out there. Even though we have those lower clearance rates, actual buying numbers are quite high, certainly compared to where they were a year ago. Now, and clearly the evidence there is in Melbourne. Melbourne had 1,160 auctions at the weekend, Michael. Very big number of auctions, well ahead of the weekend before. Clearance rate was just a little bit lower than the weekend before, 64.5%. Still higher than where it was a year ago, but once again, auction numbers in Melbourne a year ago were well below where they were last Saturday. And again, that reiterates with a similar clearance rate just how many more sales were conducted last Saturday compared to the same Saturday a year ago. Brisbane, similar auction numbers, similar auction results at the weekend. Big surge in Adelaide, auction numbers, 124 auctions in Adelaide. Adelaide's last 2 weekends has fallen below its usual 80% plus clearance rate, which we tend to expect from Adelaide regularly. So just down a little bit. Again, those seasonal factors, Michael, impacting the Adelaide market, and big numbers there of listings in Adelaide. And look, the clearance rate at 77.6%, that's still good news for sellers in that Adelaide market. And Canberra numbers down slightly, 74 auctions in Canberra and a similar clearance rate there. So as we've discussed, a surge in listings, Michael, downward pressure on clearance rates because of extra choices and extra competition amongst sellers, but also because we're coming to the end of that catch-up cycle of this year. And we can see that when we look at the trend data. Sydney's now tracking at under 70% so far in November clearance rate, which is 10% below where it was at its peak in May, and certainly nearly 10% below where it was in June as well. Similar in Melbourne, 65.5% over November so far, which is well below the May result of 77.7%, 10% below. Brisbane also lower over recent months, 56.6% in Brisbane over November so far, again well down on that May peak result. And Adelaide's just tracking below the 80% mark, as we discussed just before, 78.2%, but still a very strong market, that Adelaide auction market. And Canberra, reasonably steady at the moment, but it's been the underperformer, Michael, in terms of auction market activity, really through this catch-up market this year so far. So some specific things happening in that Canberra market, but generally these are results that we would expect, as I said, given the usual seasonal impacts and the end of that catch-up cycle with the end of the year in sight, Michael. And we should just reiterate that most capitals are going to record 10% plus prices growth this year.
I think that's really important when we're saying, look, the market's a bit quieter, there's a bit of an opportunity, but people are getting a bit nervous. Just look how well our property markets have performed in general, particularly the capital city markets. The regional markets haven't been as strong, but they've still done okay. So that was despite all those predictions of fiscal cliff, interest rate problems, property Armageddon, rising interest rates causing the property markets to crash. It's actually been a pretty good year for property as a property owner, probably not as a tenant, Andrew.
No, terrible year as a tenant, Michael. We know that, and that's not going to, I believe, get better anytime soon. We're actually now starting to track rents for units in Sydney, tracking higher than houses, can you believe? But which just is an indication of how tough it is in Sydney, and it is generally in capital city rental markets. But look, I think the point to the 10% growth, which has caught up with what was lost last year, is the fact that it just shows how resilient and robust our markets are, that they bounced back after a period of significant negative sentiment, fueled by all the usual scare campaigns that we see, and it was just shrugged off. Strong economy, connection with property, and we've bounced back and made up all the losses of last year and then some, despite having 12 interest rate increases, 13 interest rate increases now since May last year.
Well, those who are wondering, should I buy, should I wait, what's going to happen to interest rates, should get comfort from the fact that it's not just this cycle, but that's happened cycle after cycle in the modern era. So that's what the property market does. It doesn't go up consistently. It doesn't double in value every 7 to 10 years, like some say, some periods of flat growth, and then it jumps up a lot. But it's doing what it always does. And overall, the Australian property market's underpinned by the wealth of the nation, a rising population, and the fact that we want to own our own homes, Andrew.
That's right. There's that sanctity of home ownership or home investment that is really part of Australians' DNA, and we've proven that once again this year in the face of the usual outrageous predictions, more and more clickbait from desperate attention seekers. But look, the point to our markets currently, Michael, is that I don't think we've ever had such a supply-demand imbalance.
No, I've never seen that. And if you remember, all these people coming from overseas haven't come here to be tenants. They've actually chosen to come to this country to form a new life and in due course get a good job and buy a home and raise their family in the Australian way. So that's also going to be very strong moving forward for our housing markets.
Yeah, absolutely, Michael. We won't see a 10% year next year, but I think we'll get positive growth nonetheless.
Great. Look forward to catching up with you again next week, Andrew. Thank you.
Thanks, Michael.